Now. All right, so welcome everyone to the Mortgage Masterminds, the crazy adventures of COVID-19 and how it is constantly changing the environment that we are lending in. So, I've got James Addy, the DMV mortgage dude up in the DC metro area, and then Mr. Sean Rogers out in, Sin City, Las Vegas. So thank you guys for being on.
Thanks for having us. Pleasure to be here.
Awesome. So, kind of the first thing here. So I see we got a couple, I believe, new people that I'm not really sure if they work with any of us that are on the call. So, just a little bit about myself. So my name is Jeremy McDonald. I'm with Carbon Capital. So I'm a mortgage broker here in the state of Florida. Just do Florida, don't do any other state. Started in the mortgage industry back in 2003. Took a little break for about 6 years, did some commercial finance, but other than that, 17 years running. So the market is constantly changing. We are getting new overlays added every single day with everything that's going on because of COVID. But it's still a great time for people to buy and in the right situation, refinance as well. So I just kind of want to talk about that a little bit today. Since I've called in on my phone, but I've got the screen up on my computer, are you guys seeing the Mortgage Mastermind screen right now, or are you seeing, what are you seeing? You are? Okay, perfect. So James, if you would tell everybody a little bit about yourself.
Hey guys, I'm a mortgage lender here in the DC, Maryland, Virginia area. I'm with Fidelity Direct Mortgage, and my team specializes in making home buying possible. I guess the best way to put it. Really happy to be here and a part of the mastermind again this week. I love the expert opinion from yourself, Jeremy, as well as you, Sean, and thank you for having me.
Thanks for coming. We're glad to have you on. Sean, if you want to tell everybody a little bit about yourself as well.
Yeah, Sean Rogers here, Las Vegas, Nevada. I kind of do most of my work here on the West Coast, but I am licensed all around. I'm more of a, like I said, a home buyer specialist. I focus more of my time, energy on getting our underserved into new houses or, homes, period. This is my, goodness, I think it's my 15th year writing loans. If I'm not mistaken, I can't remember. Not important. But I've been around the block a few times, and happy to be here, guys. Happy to be here.
Awesome. Thank you. So the first part, we're going to go over a little bit on the jobless claims, where that's at, and new home builds and kind of some of the statistics there. So James, if you could go over these first couple of talking points.
Absolutely. So as many people know, right now, there are a lot of people across the nation filing for unemployment. So with that being said, this morning, those came in at 5.25 million. That brings us up to a running total of about 22 million people in the last 4 weeks who have currently filed for unemployment. Mortgage bonds didn't bat an eye here, and everyone kind of didn't know what an astronomical number we were going to get here, but the takeaway from the data is it had no effect on mortgage pricing here today. So I know that we're all seeing a lot of people unemployed, in our hearts and everything go out to those families in need. However, this information did not have a big or dramatic effect on rates this afternoon. So one thing to keep in mind, and I'm seeing this a lot here in my area, as we're working through an inventory shortage, we're starting to see a lot of builders get to advertising. So new home construction here looks good, despite hitting the biggest kind of curve it has in about 40 years. While the March residential construction report from the U.S. Census Bureau is grim, one can find a small glimmer of optimism in the fact that while housing starts fell off a cliff, there was much less damage done to the permits, which is a huge plus. Perhaps this means that the builders are envisioning a pause in construction rather than a total collapse. And one thing I'd like to throw out here is I know with the builders in my area, sometimes they like to see that the clients are pre-qualified before they start building the home. So maybe we'll start to see, more policies in place towards that as well here.
Yep, absolutely. Absolutely. So, when we look at kind of what's going on in the MBS and take a look at where rates are, where the stocks are, and where the yields are, it's all pretty crazy right now. So, it's a lot more effects than just what's going on in the stock market and then the bonds. So when you look at the chart there and you see how the stocks are going higher, but the 10-year yield is going lower, and it's really kind of temporary too, and it's not completely indicative of what the market truly is doing. I'm sorry, guys. I got to put my phone on silent. Thought I already had it on silent. Getting text messages coming in. So there's a lot that's kind of affecting the pricing right now. So, some issues with capacity. So because the rates were so low and there were so many people that came in to refinance, and so many lenders got bogged down with all of these refinances, the easy way for them to kind of throttle back that business because they can't handle that much volume is by just increasing their rates. So that's something that we do see that plays into this. Servicing value issues are a very, very major issue right now. So as I've talked about, quite a bit on social media and in my newsletters, and we spoke last week, the Coronavirus CARES Act was very, very careless with the forbearance. And forbearance on government loans is nearly a death sentence to government servicers, because when the client goes to forbearance or does not make their payment in general, they still have to remit that payment to Ginnie Mae. So that's huge. And with experts expecting 20% of homeowners to eventually apply for forbearance, I mean, the losses that the lenders or the servicers are going to take are just catastrophic. So with that, nobody really wants to buy government loans right now because they have the highest default rates, they are the riskiest loans, and they're the ones where that if the client doesn't make their payment, that servicer still does. So that's definitely a major, major issue. As far as repricing and things like that, we've definitely seen in the past week and a half where rates have kind of leveled out a little bit. They are a little bit higher today, were a little bit higher yesterday, but they've not had the volatility to where that they're swinging 0.75% to 1% or more in one day. So we went from 2-3 weeks ago seeing 6 to 8 reprices a day to maybe 1 or 2. So definitely calmer. And then some of the really fun overlays that have came in. So I'm a big fan of the Velociraptor, asking those great questions. If money doesn't grow on trees, why do banks have branches? Sometimes I feel like that all I do is answer questions like that for consumers. And it's a little frustrating, when you continue to get, these questions that just don't even apply anymore. People thinking, oh, I got a 580, I can get a house. Why can't I get a house? And then they want to argue with us. Like, this is what it is. It's temporary. Eventually we'll get back to something closer to what it is. But right now we just have to deal with this. So some of the new overlays, on Saturday, FHA updated their scorecards to where that on all FHA loans, you have to have 2 months reserves, just point blank period, end of the story. I will say, if that reserve money is coming from a gift, like, we have to know, because we have to run the automated underwriting system with that. Because if we think it's in their checking or savings account, because we're told that, and that money is a gift, it is factored differently. Gift money is a lot harder to get an approval on, so that is something that really plays in that. So now, with a lot of these overlays, they don't necessarily apply to all lenders, but a lot of these are ones that I'm seeing kind of consistently. So there are some lenders that are maxing the debt ratios at 40%, just period, regardless of what your credit score is, regardless of what your reserves are. Now, there's others that, if you've got a 680 or higher and you've got 3 months of reserves, that they'll let you go up to 50%. And there are some that will still allow you to go up to 50% with a 640 credit score. I will say the interest rates on those are not as appealing. And more so, the cost for that rate is not very appealing. So just kind of something to keep in mind there. Investment properties, minimum of 25% down. I've tried to price out a few of those. I don't know about you, Sean and James, but like I can't get any rates to even populate unless you're putting 25% down on investment property. And then there's a pretty decent sized cost. So nobody really wants to do those loans. And again, people that rent are at a greater risk of being in a profession that's not essential and not having income. So it's a much, much riskier loan in this coronavirus impacted world. So that's kind of the reason why. Self-employed, most lenders are either taking and reducing the average by 25% or taking the less of the past 2 years as that self-employed income. And I've seen up to 6 months in reserves required. So some are just requiring 3 months, but there are some that are going up to 6. Rental income is another one where I'm seeing if you want to get qualified with using rental income, that you have to have 6 months reserves for that rental property to be able to use that income. So what that means is if you have a rental, and let's say you're renting it out, let's say it's a duplex and you're renting 2 units out, $500 each, and your mortgage on it's $500. Well, so you're actually making $1,000 a month, but to use that income to offset that $500 payment, you would have to have 6 months of that $500 payment plus taxes and insurance if it's not included to even be able to use any of that rental income. So that definitely plays a part into it. So whether or not you have someone looking to do an investment property or they're buying and they have an investment property, that's definitely something to kind of keep in mind. So first-time home buyers, 12-month rental history has to be able to be verified, has to be in their name. If they're living rent-free, unfortunately, that's not a rental history. In those cases, if they can't verify a 12-month rental history, we're seeing that they need up to 6 months in reserves. Again, this is after down payment, this is after closing costs. So that gets rid of a lot of potential first-time buyers right there. Overtime, commissions, bonuses, using the lower of the past 2 years. So like I had one guy who in 2018, he had $1,300 in overtime. And in 2019, he had $6,900 in overtime. Well, it's not an average anymore. It's the lower of the 2 years. So all we can do is that lower amount. So that definitely does affect. One of the ones that I saw come out today was age of documents, specifically credit reports, that a credit report has to be dated within 30 days of the contract. That is big. That is really, really big. Like I want to go into a story about it because I have a situation that is very applicable to that right now. And I tried to tell somebody, they didn't want to listen to me. And I'm just waiting for the phone call in a couple of weeks of them saying, hey, Jeremy, can you come rescue me? And I'm going to be like, sorry, I can't. You should have listened to me. But that's going to happen. So.
And then, Jeremy, I don't want to steal your thunder on this, but I think it's very important we drive this home. You know, I'm seeing this quite a bit where, you know, I have a deal that I'm personally working on right now. And the items that were sent over to me, you know, one of them was a pay stub from 2 months ago, you know, and just like you mentioned I was talking about reports and you're talking about the new requirements. It's really important that we stay up to date on the finances of our clients because things are changing so rapidly.
Absolutely. Absolutely. They are. Sean, if you want to go ahead and grab this next one, talking about some of the pre-closing additional verifications of employment. I actually ran into this yesterday. But the floor is yours.
Yes, thank you, Jeremy. Thank you. Yeah, so this, I had a problem last week with this file, one of my files. I don't know why this happened, but one of my group members went an extra step and did another written VOE prior to closing, and it showed a decrease in income. Now, they usually don't ask for a written VOE prior to closing. I do not know why they requested one. I think it was an error on the transaction coordinator's part. Killed the deal, right? Because it showed an expected decrease in income. A verbal would suffice. I could have funded the loan, but it is what it is. So we have to try him again in a few months. Now, one big thing that I have here is the borrow attestation form. So what a lot of lenders are doing that I'm seeing out here, a lot of lenders, a lot of brokers, they're verifying and saying, hey, customer, look, uh, we're going to give you this loan for this house. We're going to give you the funds, fund you, give you your house keys, right? We want to make sure that you're not relying on a forbearance to make these payments for the next 6 months or to give you some relief. For the next 6 months to 12 months, we need to make sure that you are able to make these payments regardless of the environment around us, right? This is to protect the lenders, the originators, and the borrower themselves too, right? There's no need for you to jump into a house because you think the feds are going to bail you out um, in the next 3 or 4 months, right? That can cause a wave of issues down the line for everybody involved. So when you're realtors, when you're doing your your first meet and greets with the customer, same thing for us LOs. We need to make sure that the borrower feels that they're in a job field or have employment or income that's going to last them through the next 12 months. That's extremely important. So make sure we have that talk with our people prior to going under contract, and of course during contract before we close. Make sure everybody knows that. Now, once we get to the final closing, or we're about to close, or get the clear to close issued, uh, four things are going to happen. Well, one thing is happening is re-verifying the employment. So I know all of us have had people that they're about to close in the house, and for some reason they quit their job or get a new job. Happens all the time, right? Unfortunate, but for some reason they think it's okay because they got the clear to close. First thing they do is a verbal verification. So the processor calls either HR, a receptionist, or whoever it might be, to say, hey, does Bob Smith still work for ABC Company? And they say, yes, of course. Okay, good. Then they hit the button to fund. Also, this is huge too. Pay stubs. Pay stubs, like Jeremy said earlier, were used to be good for a cool 30 days, a shelf life of 30 days sometimes, or sometimes 45 days, depending upon how they are paid. Now they're only good for 10 days. So keep that in mind when you time your closings. Make sure when you have your initial talk with your customers, like, hey, what are your pay dates? What are your due dates of your paycheck stubs? Um, and this will avoid doing a written VOE. We don't want to do that. We want to do a full, just look at a pay stub and make sure everything still lines up, make sure the hours are still there 10 days prior to us hitting the red button to fund the loan. Okay. Um, Also, we want to check the deposits into the bank. Now, in some loans, I don't really necessarily need bank statements, and this is mostly on refinances, right? But when it comes to purchase transactions, we're pretty knee deep into these bank statements. We need to make sure that the paycheck stubs and the HH deposits match. Okay, either we need to make sure that they're not sending money to some other bank account, right? There's just different garnishments, whatever it might be. Need to make sure that those figures do match. Another way that they're verifying the employment is verifying with HR. The downside to that is sometimes a lot of these HR reps are working from home now, especially for my loans out in California. We can't reach anybody in the office. So we have the borrower do, once they go into contract, or if they can possibly, reach out to the HR team and say, hey, I'm going to be buying a house in the next 30, 45, 60 days. I need your cell phone. I need your cell phone. I need you to give me your cell or your personal email just in case you are off. We can't reach you. I need to have your personal info. This has saved my rear end a couple of times by having the HR rep's personal information. Okay, so make sure these things are done if you can. Upfront in your the buyer meet and greet when you have your initial conversation with your buyers. Make sure these things are done or at least touched on, so they know what to expect at and prior to closing. Also, it's a good idea to make sure you remind the buyer, because there's so much going on in the process when you're buying your first house or another house. Um, Keep drilling these points into their head throughout the process if you possibly can, because sometimes when we deal with our buyers, it's going to go in one ear and out the other. So just to ram the point home, say it over and over again to them if you can. Just remind them, send them emails, text messages, etc. Depending upon the situation and condition of your potential new homeowner. Okay. All right. I think that's it.
All right. Thank you, Sean. So I'm a huge Tim S. Grover fan, I guess. So he was Michael Jordan and Kobe Bryant's trainer. Has a great book called Relentless. So this is one of the quotes from that. So create the results so intensely that the work is irrelevant. I really kind of just, think about the things that you do and why you do them. And when you really have that strong why of why it is that you do what you do, and you have that end goal, like the things that you got to do to get there really don't even matter. It's just all about getting to that destination. So with that, we also all completely understand this is a difficult time. I am the type of person, I love to get out and go do things. I like to go to Chili's and have some 2-for-1s and whatever. I love going to concerts, movies at the theater, Jags games, whatever. So being stuck in the house all the time is crazy. Like every day just seems like it kind of melts together. It's difficult. So, you got to do some different things to kind of get yourself into a good mind space. So 4 critical questions that you should be asking yourself now. Ask yourself these. So, how are you doing? Take some time with that. Don't answer it too quickly. Nothing knee-jerk, not a thought list, but really how are you doing? Really evaluate that and find someone that you can talk to about that. So, I'm definitely not a psychologist, and a lot of people right now are putting up a facade to cope with this crazy crisis that we're going through. And, that's okay. And I mean, there's times I have to do that, put on the happy face. I get somebody that says, hey, I've got a buyer that wants to put a $300,000 contract in, and it's 9:30 on Friday where the week's been crazy, and I have to do it. So just make sure that you're not getting overwhelmed, underneath all that. So ask yourself, are you okay? Are you taking care of yourself? Are you talking to enough people? Are you having enough of that social interaction? Are you seeing the different content that I'm putting out, the content from last weekend? Are you putting that into place? So, also making sure that you let your loved ones, your friends and your family know that you hope that they're happy and healthy. And if not, reach out to your friends and your support network that you have, and talk to them, because I mean, this is a difficult time. So the second question to ask is, what have you learned? So what have you learned about yourself during this time? So it's always a good idea to kind of step back and take inventory of yourself every once in a while. And now is especially a great time for that. So it's important to make sure you're dialed in and paying attention, not just skating through all this. Don't want to be on autopilot. So, hoping and waiting for things to return to normal, that's a recipe to getting out of this industry and losing your career. So chances are you've never been through anything quite like this, because what we're experiencing right now really hasn't been around before. So, you may be discovering new traits about yourself that you never before realized. I was talking to someone talking about how they're learning how to sew during this time. Grown adult learning how to sew. I mean, that's great. If you're learning new things, what are they? To me personally, I've definitely learned that pressure is something that gets me turned up. I try to be a high energy person. Situations like this are fun for me. I like to solve problems. I like to find creative solutions. So as much as I hate being in my house all the time and I hate not being able to go do things that I love, it is pretty cool getting to see different creative solutions that I can come up with. So how have you grown from this? So, growth comes from a bunch of small things. It's a bunch of things adding up, and it's over time as well. So nobody wanted this crisis to happen. Nobody wanted it, but it has. So when the world gets turned upside down, it sometimes causes us to stretch and adapt, to shake it out, get out of our comfort zone and look at things differently. So in other words, it does cause us to grow. So have you seen yourself grow during these last few weeks? I mean, I've got quite a few messages from different people talking about, after knowing me for years, they finally, took a plunge in something, whether it's starting to do, market updates for your target market, talking about the housing market, talking about the mortgage market, whatever it is. So it's pretty cool. That's growth, and that's learning new skills, and that's emerging from a crisis in a positive way. So the last question that I have for you guys is, where do you need to sharpen your axe? So one of the ways to always continually grow is by knowing your weaknesses and focusing on improving your weaknesses, because then you get more consistent. So question 3 was more about natural growth. This is a little bit different. So this is more intentional perspective growth. So, what topic have you been telling yourself for years that you want to learn or need to improve? What aspects of your business cause the most breakage when it comes to transactions over the years, and how can you fix that? Where are you losing money, and how can you fix that? So what skill have you always wished you had possessed, but you told yourself that you weren't born for it, or you didn't have time to learn it? So ask yourself these questions and find ways to make yourself better, so that when we come out on the other side of this, whether it's 30 days, 90 days, 12 months, 18 months, we don't know. But when we come out of this, what are the things that you can do and focus on to help you come out stronger and better than ever? And so with that, you guys got questions? Now, Sean, I know that you've got a very specific question quite a bit. So while the other people on the conference call are thinking about their questions, what was the one that you keep getting?
The one that I kept getting over and over again when I'm pre-qualifying someone and we're going through, all the basic steps and whatnot. Number one, should I wait to buy a house because of the pending, or their idea of a pending foreclosure crisis? They're seeing the reports out there with Market Watch saying that, hey, forbearance requests are in the millions, and a lot of the servicers aren't properly explaining to their customers how the forbearance requests work. Is that money going to get deferred, or is it going to actually go into forbearance? And a lot of folks are just thinking, take all of the government help you can take, because that's what it's there for, but it's a two-edged sword, so it may not be in their best interest. So a lot of folks that I talk to, they're kind of thinking that they should wait and maybe pounce on, they're thinking like, what happened in 2008, 2009, pounce on a super low purchase price as opposed to, pay more right now. That's the main question I've been getting.
So do you think that's going to happen?
I can't see that happening. No.
Yeah.
No.
So I can't either. So why can't you see it happen?
I can't see it happen because of the number one, our chartered recovery path that's going to eventually come to fruition. Two, the government help that's kind of stepping in. 3, we have, unemployment that's been increased. We have stimulus that's been increased. People are able to actually make their payments. Second, we had up until this point, our underwriting was extremely strong. We weren't giving loans to folks that could fog a mirror, right? It's a lot stronger market as opposed to the house of cards things were built on back in 2006 and on, right? So I can't see us stepping into that arena. So I try to tell my people like, hey, there may be a few foreclosures. Some people's jobs aren't going to come back. They're not going to recover from this. Businesses will be shut down and they will close. But as a majority, housing will still be quite strong, especially when it comes roaring back. We're hoping for a V-shaped recovery. And with that, home buyer confidence will increase. People will be raring to get back to work. People are going to want to spend their money. It's definitely we're going to recover. Now, when? I'm not sure. Also, I think the word is kind of getting out more. When I see posts on social media, and sometimes they're a little bit off, but when I see posts on social media, people are really kind of in tune now as to what a forbearance means. Right? There's more information out there as opposed to 2006, where we could usually get you couldn't get that much info about your situation or how to resolve your problem. These days, a simple click of a button, you can get all kind of articles and blogs showing what's going to happen if you do a forbearance on your home. People are a little more informed as opposed to back then. So I can't see us really going down that road. Heaven forbid. I'm not an economist, right? But I just can't see it happening again.
Yeah, I mean, I definitely agree with those points that you're hitting on. And I mean, I've gotten quite a bit of, hey, should I just wait 3 months to buy a house because won't I get a great deal? You know, aren't there going to be some foreclosures? No, it takes a whole lot longer than 3 months for there to be foreclosures. So if you have someone that lost their job last month, and this is the first month that they didn't make a payment, let's say they do forbearance. Let's say they do it for 12 months. And then 12 months from now, they're faced with having to make 12 payments, and they can't do that. So list pendants gets filed, then they go into a foreclosure status. That's still months after that before that home actually goes to foreclosure. Depending on who's the servicer of that mortgage and who's the asset manager of that, and depending on how many other homes are in their portfolio, they could go, okay, well, we're going to go ahead and put this one on the market now, or it's just going into inventory and every quarter we'll check and maybe it'll go on, maybe it won't. So someone that defaults now because of this, you might not see their home available for sale as a foreclosure for 1.5 years, 2 years, 3 years. There's just no way to do that. So to play a game of, hey, I'm going to wait a few months, try to get a foreclosure, is not realistic. And again, like Sean was saying, there's so much more information now. So it's definitely a completely different environment than it was last decade.
Exactly.
So any other questions?
Well, yeah, I've got one more thing I've been getting from my customers as far as the future of interest rates. I mean, in a perfect world, this kind of goes back to your slide you're doing on mortgage-backed securities in the secondary market. In a perfect world, we see a 0.6 to 0.7% 10-year T-note. On the consumer side, we're supposed to see, right, what, 2.5, 2.75 30-year fixed rates, right? But because there's so much going on and so much uncertainty, we can't offer those rates. It's not out there right now. We're far from that, right? I think that consumers need to know, not need to know, kind of have a feeling as to what's going to happen in the next 6 months. Once we reach the point where as we reopen and it's more mortgages are more of a, not of a safe haven, but more profitable to our secondary market, our investors. I'm hoping that I'll be able to tell my customers, rates are going to drop back down. But what do you think rates are going to be at? Let's just say, for example, we open the country back up for business over the course of the next 90 days. At what point do you think we'll see those lower rates again, if at all?
Well, I mean, we're still in very, very low, historically low rates. So when do we go from that top tier client that can get a 3.25 or 3.125 and then get down to that 2.625, 2.75? It's hard to tell. I mean, if 90 days from now the country has opened back up, then I mean, I think that within probably 60 days, 90 days, we should probably start seeing rates closer to that. But I mean, we're still talking about not really a huge move in it. So, and there's also a lot of unpredictability in that. If the country doesn't open up in 90 days and it's 6 months from now, or it's 12 months from now, or if we open the country up and it was too soon and then all of a sudden, infections and deaths spikes and it puts us in a situation to where we truly are locked down in our houses for a very long period of time, I mean, if the government starts printing money, we can be dealing with, high levels of inflation, and then all of a sudden, yeah, you could have got a 3.25 or 3.5. Now all of a sudden you're looking at getting an 8% interest rate. So it's one of those things where it's like, do you want to risk waiting and losing the opportunity to get a 3.25 just so that you might be able to get a 2.75? Do you want to do that? And then what are you right now? So like if right now you're at a 3.875, okay, maybe. If you're at a 4.5, you're at a 4.25, and you can get down to 3.25 or 3.5, like you should do that. Waiting to hope that it gets down lower, I don't know. And I mean, what happens if you do end up losing your job a month from now? You have a late payment on your automobile, whatever, and then all of a sudden your credit drops from mid 600s, high 600s down into 500s, and now you just lost everything. Now you got to go through trying to get your credit better. So, I mean, if you can get a great rate now, you should get it. Hopefully they get better, but no one can tell the future.
Right. Understood.
I'd also like to care to add where I've heard or seen for some competitors where they're working with some of these people with lower credit scores, and then you get a fee estimation sheet and you see that some of these people are charged maybe 2 or 3 points, and now we're entering a higher cost mortgage to those people. So I'd be very cognizant of that as well, not overspending, just like what we're.
Yep. Yeah, and even with that too, if you've got a buyer that's buying in that 120, 140 price range, and you know that they're in the low 600s, we can't give them what's called a par rate. Their rate is going to have discount points attached to it. There's nothing that we can do about that. So if they're buying a $120,000 house and it's coming with a 2% discount, we're going to run into issues with high-priced mortgage loans, and we might not be able to get that deal done. Might we be able to get them an approval? Sure. But actually close the loan? We might not. We might not. So, and that's kind of just managing your pipeline. If you have the lower price points and they also have bad credit, or they don't have good credit, they need to work on their credit. If you have people that are in the low 600s, but they're in the $250,000, $300,000 price point, okay, that's a little bit different. We have a lot higher odds of getting that loan actually closed. So it's just kind of being conscientious of your pipeline, of your buyers, and managing them accordingly, and spending the appropriate time with ones that can buy now versus the ones that can't. And then I would say something that everybody should really, try to do is at least once a week, go on Facebook and Instagram, whether you're going live or if you're just recording the video, and give an update of your market, of where you're at. Go into your local MLS, pull the prior month, pull what's on the market, pull the new listings, pull the pending, and do a quick video. Let people know, like, hey, people are still buying and selling. If you're not buying and selling, if you're not representing a lot of people at this point in time, share the victories of other people in your office. Hey, I'm with Berkshire Hathaway. Business is booming. This past month, we had 876 people go under contract for the purchase of a new home. Yeah, you didn't have 876, but your brokerage did. So there's always a way to have a positive message. Any other questions?
Oh, I think I'm questioned out.
All right. Well, I appreciate everyone hopping on the call. We're glad to be able to share the information with you. We're also going to put this on Facebook. I see you now, Marlon. We're going to put this on Facebook. So, tag any realtor friends that you have. Get it out there. So, Marlon, do you have any questions?
No, sir. I had a problem unmuting. Man, everything was great, man. It was a great session today. Took a bunch of notes, and I definitely appreciate everybody for all their input and content. And put on. It was a great presentation today. I'm surprised we didn't have more on, but they missed out. and when we got those nuggets. So beautiful thing.
Yep, absolutely. So thank you for being on the call.
All right, thank you.
All right, everybody, have a great and safe weekend, and we'll see you next Thursday.
All right. Take care, everybody.